Okay, so welcome to all participants. I'm Matthew Rablan of the University of Sheffield and TARC. We've got 3 papers this morning, and we're going to start with a fellow TARC member of mine, and that is Luca Salvadori. So, Luca, it's been a long wait, but I'm finally going to hand this over to you.
Okay, thank you very much, Matthew. So let me just start by saying that the discussion so far at this conference has been really fruitful, and I've learned a lot from all previous presentations, from the panel sessions and the plenary sessions. So thank you very much for that. This work is the result of a joint effort of TAC and the Rwanda Revenue Agency. And apart from Christos Kotsogiannis and myself, other team members from the agency are involved in this and significantly have contributed to the study. So for this reason, we have a disclaimer saying that basically what I'm saying today is not necessarily representing the views of the agency and its management. So as some other presentations in this conference have already highlighted, tax audits are crucial parameters to collect more revenues within a progressively more multidimensional tax system. However, administrative capacity is still generally limited, and this is especially true for low-income countries, something that we have already discussed with the panel that we had yesterday. And basically because they have even more reduced resources to devote to the enforcement of the existing tax code. And this is particularly true after the unprecedented COVID-19 crisis. So this has opened the debate among academics and policymakers on the importance of understanding these policies, which has led to a proliferation of studies, all framed in the developed country context, investigating the impact of tax audits on taxpayers' reporting behavior. Intuitive arguments can be raised in support of both potential directions of the impact. So on the one hand, audits may deter future non-compliance because conditionally on being found non-compliant, they increase the perceived probability of taxpayers of being audited again. On the other hand, audits may increase non-compliance because audited taxpayers may think it is unlikely for them to be audited again soon. So independently of the type of audits, risk-based or random, analyzed, which entails symmetric advantages and drawbacks in terms of external and internal validity of the analysis, we can say that most of the papers in the previous literature tend to document a positive specific deterrence effect of the audits on taxpayers' future compliance behavior. And there is also a certain consensus of the persistency of the analysis of the things that matters. But in general, there is a lack of evidence for developing countries. Of course, there is a huge literature focusing on tax compliance issues in developing world, but there is a lack of a study analyzing this specific effect of audits. And so this study aims at filling this gap in the literature, and it's important to do this because, as I said before, there is a need of enhancing fiscal capacity in this context, and also because audit assessment might lead to slightly different results. So just to give you a flavor of our study, our main research questions are 2. So are tax audits deterring future non-compliance on corporate income tax in Rwanda? And what is the impact of different types of tax audits? Something that has been discussed also previously in this conference. So different audits, different types of audits might have different impact on the behavior. So to answer these questions, we are going to combine 3 sources of data. We have been granted access to the universe of corporate income tax, but also value-added tax anonymized tax declarations for the period 2011-2018. We have been also granted access to the universe of risk-based audit data, anonymized, of course, for waves. And we have also the information on the detailed risk rules and criteria and the corresponding risk weighting scheme that has been used by the agency to flag targeted audits. So given the nature of our audits, targeted risk-based, we are going to combine an approach we're going to use an approach that combines matching and difference in difference. I'm going to tell something more about this later. And in general, this is a work in progress, so the results are still tentative, but we provide evidence of significant pro-deterrence effect on corporate income tax reporting 1 year after the audit, not significant after 2-3 audits, 2-3 years. And we also provide evidence that comprehensive audits, in-person, in-depth audits, tend to drive the results, while desk and issue audits that are desk-based, not in person, tend to have the opposite effect. So now I will go through the institutional setting and data, present the empirical approach and the main results. So Rwanda certainly is a very interesting framework to analyze these issues for several reasons. First of all, it's a representative low-income country in terms of both fiscal capacity and administrative capacity, but major efforts have been done to develop capabilities fast, for instance, in terms of applying risk-based selection for audits. It is also a country that has a similar tax structure to other developing countries. And interestingly, there are a few ongoing studies on related compliance issues that focus on Rwanda. So the data that we have comprises the universe of corporate income tax declaration, as I said before. This is a tax that is levied on income generated by incorporated businesses at a standard rate of 30% of profits. But there are some reductions for some groups, for instance, new companies or companies employing Rwandan nationals. And there are also simplified tax regimes. For instance, for small firms, there is the option to opt for a simplified revenue-based tax regime with a tax rate of 3% of the turnover instead of the profits, and flat tax regimes for microenterprises. So here you can see the distribution of firms by size, even if it's a tax on incorporated businesses, where we can see that the large majority is microenterprises. We have to say that most of them, like the 55% of the whole set of tax filers, are indeed the nil filers, as already flagged by Mascagni and co-authors, meaning that they are basically reporting zero in all the fields. Something that you can easily see here on the distribution of business income. There is a huge mass of density on businesses reporting zero. So we have also the distribution of just the firms with positive income, and here the total number of declarations. The type of the audit data that we have, again, is the universe of audits done by the authority across 4 waves. The wave has been defined in a way that basically is based on the start of the date start, sorry. Defined in a way that audit is assigned, for instance, to 2013, if conducted the fiscal year before the taxpayer reported their 2014 declaration, in a way that 2014 would be the first year of impact. There are different types of audits. The desk audits are conducted using information already submitted. Issue audits, again, desk-based, tend to focus on a specific aspect and specific tax periods, but then there is this comprehensive audit category that is a category of audit that is in person, in depth, and time intensive across tax bases. So we suspect that there is a different impact depending on the type of audit. So we are going to take this into account. Also, we have been granted access to the whole set of criteria for risk-based selection. And this involves a lot of information, including from other tax bases. And we are going to use this to replicate the risk scores, and also exploiting the risk weighting scheme for all the taxpayers. So we are also exploiting information from other tax bases, specifically VAT. So what we want to estimate is the average treatment effect of audits on treated tax filers' reporting behavior. And so we are denoting here with delta Y1 the change in individual I's reported outcome, that could be taxable income or tax payable, if the taxpayer has been audited, and with delta Y0, the analogous change if the taxpayer was not audited. And we are indicating the treatment assignment with D, dummy equal to 1 if you receive the treatment. So this difference is basically representing the average treatment effect of the audit process on the treated. And while the first term is easily estimated, employing the observed income reported by audited taxpayers before and after the audit process, the second term is counterfactual because we cannot observe at the same time the change in the reporting behavior of audited taxpayers had they not be audited. So since we are using risk-based audits that target tax returns that are most suspected of non-compliance based on a certain set of covariates, this is going to a certain set of covariates that are basically influencing both the treatment and assignment and the outcome. This entails a selection bias, and so we cannot estimate this by simply using the average, let's say, change in the reporting behavior of untreated taxpayers, because this, as I said before, entails a selection bias. So to tackle that, to address that issue, we are going to combine matching methods, different matching methods, with a difference in difference approach. So the most common matching methods involve finding for each treated unit a set of control units that are similar to the treated in the covariates. And the distinction between methods is how to define this similarity. So more precisely, we want to estimate this basically using a weighted average of the change in reporting behavior of the taxpayers in the control group. And basically, the key goal of matching is to weight observations from the data so that there is a better balance between the treated and control groups, meaning that empirical distribution of the covariates in the two groups is more similar. So the distinction between the methods is on how these weights are calculated. Basically, this is a general formula to say that these are the weights, and this is what is changing. There are several matching techniques available in the literature, not saying much because of time constraints, but ideally exact matching tend to matches exactly on all the covariates, the treated and untreated. So the pro is that you obtain a perfectly balanced data set, but the disadvantage is that it's not possible to match all the taxpayers. There are several approximate matching methods that basically specify a synthetic measure on which to match. And for instance, a very popular one is propensity score matching that estimates the probability of being treated given those covariates. The pro is that it's convenient to match on a synthetic measure and do overcome the limitation of this approach. But the cons is that there is a back and forth process because you have to set the size of the matching solution ex ante and then check for the balance exposed. Coarse and exact matching is the main approach that we are using, even if we are also using propensity score matching and other techniques. The idea here is that the algorithm temporarily coarsen variables into meaningful groups. So basically dividing the distribution of all the covariates into bins and creating bin signatures for all the taxpayers in a way that then you match exactly on the bin signature. And then you balance original matched data through weights. What is the pro is that you can basically set the level of imbalance ex ante, and also this technique tends to perform better in terms of balancing. In terms of the variables involved, we are going to use, in the matching technique, we are going to use the risk score. We estimate the tax income the taxable income in the 3 periods before the audit process, but also other set of variables that includes other variables, for instance, VAT paid on imports, sector of activity, index of sources of income, tax center indicators, and the lag of these variables. Propensity score matching, propensity score is predicted using the whole set of these variables. Let me go very briefly on this. Before to apply the matching technique, we are going to skim from the universe of taxpayers. We're going to apply some restrictions. For instance, we are requiring taxpayers to file timely and chronologically, and we are focusing on one specific wave in order to estimate the effect of that specific wave of audit. And yeah, this is basically the final sample that we have, in which we have 84% of the audited taxpayers in. Very briefly on these two, so to measure imbalance, we are going to use statistics introduced by King and co-authors that basically it's a way to measure relatively imbalance before and after matching. So it is bounded between 0 and 1. So 1 means complete imbalance and 0 perfect balance. So we have before matching 0.61 level, and after matching at 0.28, meaning that the imbalance is substantially reduced, and also at univariate imbalance is substantially reduced for all the variables involved. So these are the results, the main results. As I said before, we are also using alternative matching techniques, and we are using two dependent variables. So given that these dependent variables are expressed in logs, the results can be roughly interpreted as elasticities on the dependent variables that are not expressed in logs. And so you can see that there is a significant impact of audits the first year after the audit has been implemented across all the different matching techniques that we are using. And on average, the impact is roughly 20% more taxable income reported by audited taxpayers, and roughly speaking about on average 12% more corporate income tax payable reported 1 year after the audit process. So while the magnitude of this impact tend to be lower the second and the third year after the audit is implemented, these values are not statistically significant. So graphically, this is what you get. What is worth noting here is that the parallel condition that is necessary in any difference approach is satisfied, because we have this common trend between control group and the treated group. So this is graphically the estimated impact of the audit process that is statistically significant, at least for the first year. More or less the same story for the corporate income tax. If we estimate the effect, let's say, differentiating our sample depending on the outcome of the audit process, we can see that the result is driven by audited taxpayers determined uncompliant. We have basically the same identical result as before, while the analysis is not conclusive for determined compliant. Even if we see something interesting here, but we cannot, conclude anything particular. We have also to say that the determined compliant are a minority, it's like just 10% of the all audited taxpayers. So another thing that we wanted to analyze is the differential impact of different type of audits. In this case, we rely on inverse probability of treatment weighting. Basically, in this case, we are estimating a multinomial logit model of audit selection, and basically the weights that we are applying in the estimator, that the general format estimator is basically the ratio between the propensity score of receiving a comprehensive audit versus not being audited, and the propensity score of receiving a desk audit versus not receiving an audit. So what you can see here is that the impact is driven by comprehensive audits, so audits that are in-depth, in-person, across different tax bases. And this is in magnitude higher than the value that we have seen before in general. And also for desk-based audits, we can see that the impact, even if it's not significant, is close to zero the first year, and interestingly, is going to be producing the opposite effect from the second year, which is a result that also has been found by Erhard, Kasper, and co-authors in another ongoing research that focuses on US, which is something very, very interesting. Yeah, let me wrap up because I see that I'm very close to the end. So this is a work in progress. Of course, we are doing a lot of robustnesses here, using additional matching control variables, for instance, applying different coarsening algorithms or identifying different thresholds for matching, and being stricter on the sample selection that we have described before. This entails reducing the dimension of the matched sample, but leads qualitatively to the same results. And yeah, so to conclude, we provide evidence that tax audits have a pro-deterrence effect on corporate income tax reporting behavior in Rwanda. This is the first evidence for developing country. Audited firms declare more income the first year after the audit. The effect is lower in magnitude, but not significant when time passes. And the effect tends to be driven by uncompliant taxpayers and the type of audit that we flag as comprehensive, in-depth, in-person tax audit. Desk and issue audits tend to have the opposite effect on the second year. So this is basically what I wanted to say. Thank you very much for your attention, and I'm now happy to take questions.
Thank you, Luca. That was an excellent presentation. So if you have questions for Luca, please go ahead and type them into the chat box, and we'll get them to Luca one way or the other. While colleagues are perhaps mulling over what you've said, Luca, let me kick the debate off, if I may. So you said you wanted to understand whether developing countries might be different from developed countries. So what was your conclusions on that particular front then? Did you detect systematic differences between developed and developing countries or not?
No, apparently we tend to show that so our estimates tend to show that the results is current with the results that we have normally let's say seen in previous contributions in the literature, both in terms of the average effect that is pro-deterrence, in terms of outcome. So it tends to be driven by uncompliant, and in terms of type of audits, which is very interesting. Probably we have been discussing this also last week in a ad hoc specific workshop that we had on this issue, so on this topic. And probably this is due to the fact that the taxpayers that are audited on a specific issue, a specific aspect of their reporting tax return, if they are not flagged as uncompliant, then they tend to take advantage of this and report less. I've seen some questions here.
Yep, if you can see those, go ahead. Yep. You got one from Sean and one from Guy.
Sean, yesterday in roundtable discussion, we heard that revenue agency in Rwanda relies on desk audits following the pandemic. Do your results suggest they should not? Yeah, probably it's a bit, maybe we cannot get to that conclusion yet, but it seems to be that one, the direction. To be honest, as I also flagged yesterday during the panel discussion, it could be that the behavior is in this specific period during the pandemic is specific to the unprecedented, let's say, situation. So maybe it's worth exploring this specific aspect in this specific context, let's say, more in depth. But in general, yes, the results, maybe it's not the time yet to take conclusion on this, but it seems to suggest that the comprehensive audits are more effective, and so resources should be, let's say, focused on this type of audit. But in general, yes, it would be interesting to deep the behavior in this specific, because I suspect that cooperation could be higher during this period. So then there is one from Guy Malley. Thank you for your very clear presentation. Has your research been able to consider whether changes in staff at the audited businesses affect post-audit levels of compliance? You mean, I guess, changing staff in the firm, not in the revenue agency? No, we are not able to do that because we don't have the data on this. But it would be really, really interesting indeed. But we are now in the process of deepening the analysis and discussing with the revenue agency with what are the further avenues of this research. So I will take this as a really good suggestions. Then from Martin Siegel, have you thought about how the theoretical differences in effects of desk and comprehensive audits relate to practical differences between these two? I can imagine that in practice, there is a gray area between the two. A gray area, you mean in defining them, I guess. I think that at least for one, that the definition of the type of audits is pretty clear in the sense that comprehensive audits are audits in which the firm receives a visit from the auditor, and so there is no, and they are basically going through all the books, the accounting books of the firm, and so it's desk-based audits. Indeed, they are based on information already submitted. In any case, that there is a notification to the firm, so they are aware that they are under an audit process. But yeah, about the theoretical differences, maybe we should think about that. Also to interpret the results, but in practice, as I said, I don't think there is a gray area. Again, from Martin Siegel, and can there be underlying factors that drive the choice for a desk or a comprehensive that affect your result? You mean on the behavior of the agency? Yeah, there are specific rules to flag so in targeting any audit, they are applying specific rules for the type of audits too. So yes, the answer I guess is yes, but we are still deepening with the revenue agency all the aspects, let's say, of the process itself. So yes, it's something that is definitely worth exploring more. So yes, thanks, Martin.
Thank you, Luca. That was an excellent session. Pretty much out of time, and there's nothing more I can see in the chat box. Thank you then, Luca. I think we shall move on to our next speaker.
Thanks, Matthew. Let me unshare.
And so we welcome to the floor Kristian A Prasetyo. Hope I've got that vaguely correct.
Yeah, that's fine.
So, Kristian, you have 20 minutes to talk and 10 for questions, if that's okay.
Oh, that's fine, yep. Should I start my share screen now?
Yes, please. Yep, we can hear you and see you.
Yep. Just a second. Can you all see my slides?
I can see your slides, yes.
Okay, done. Okay, thank you for having me here, Matthew. Good morning, everyone, or should I say good evening, because it just passes the 6 o'clock p.m. mark down here in Jakarta. Okay, I'm going to talk about my preliminary results from my research on the social dispute between taxpayers and the tax officers. The research started out of a concern that the Indonesian revenue is clearly depending on the corporations and very much less depending on individual taxpayers. As you can see on the slide, this part is the significant part of the income tax revenue, which is from corporation. And there's this tiny box here representing the small portions of individual taxpayers towards the overall income tax revenue. And this trend has been happening for the last 15 years or so, at least. This is the data that I have, and data that held with me is just from 2004 until last year in 2019. This is based on the government audited financial report. And it clearly shows that the low portion of individual contribution of individual income tax is roughly around 1%, which is for corporation, this is around 30%. And it seems that the trend is pretty much stable. And as such, there is quite reasonable to believe that this trend is going to be like this for a foreseeable future, unless we do something about it. So this also provides an indication of the low compliance of individual income taxpayers, as they simply perhaps not pay their fair amount of taxes. And I know that we all know that there is a whole lot of factors, a container of factors basically, that can affect the compliance of individual taxpayers. And I'm not going to talk about all of them. I'm going to focus on one tiny aspect, which is what I call the social distance. Now, what is social distance? There are 3 people all lying on the bed in the same bedroom. They are physically close to each other, but they are busy with their own gadgets. So I'm pretty sure, well, perhaps they're physically close, but socially they might not be. Whereas here, now, us talking here, you're up there in the UK and I'm down here in Jakarta. I'm basically 7 time zone away from you, but we can interact with one another. We are definitely under the tyranny of distance, but socially, I don't think we are. Socially, we are close to each other because we interact with one another. And in terms of taxes, if you are distance apart, especially socially apart, then it can be rather difficult to make taxpayers comply with the tax rules, because the greater the social distance is, well, the lesser the compliance level of taxpayers are. So what I'm trying to do here is basically pretty simple. Is this what is happening right here in Indonesia? Is the social distance between tax officers and individual taxpayers are so great that it is difficult for tax officers to make individuals basically comply with tax rules? So that's the whole idea. So to answer these questions, I was asking around 300 taxpayers who was attending a workshop on basically tax education for small business owners. This workshop was conducted by my campus, coordinating with the tax office, and the workshop was basically it was a 2-day workshop. There were roughly 200 taxpayers, and I asked them to complete a set of questionnaire. The questionnaire was based on the social distance score from Emory Purgatus, which is quite widely used among social scientists to measure the social distance between two ethnicities. The reason why another reason of using this questionnaire is that the questionnaire is really simple. You can actually finish the whole set of questions in less than 3 minutes. So yeah, the questionnaire was distributed online, and I asked the participants of the workshops to basically complete the questionnaire online. So what is the result of the questionnaire? So before I delve more on the results, I would talk a little bit with one particular community, basically a group of taxpayers, which is called the Friends of Tax. This group is rather special in the sense that they work really close with the tax office. This is some of the work that the two parties bring together. The members of the Friends of Tax community, they often use the facilities provided by the tax office as a showcase of the products of their members. And on the weekends, it is often that the tax office is turned into a marketplace, like you can see here on the right side of the picture. And since they often work close together, I suppose they have a low social distance. So I also asked the members of the group of this group of taxpayers to complete the same exact questionnaire. And this person here, his name is Sodik. He is basically a leader of the Friends of Tax community. Here he is showing a banner. He's standing in a banner, showing that the members of the Friends of Tax is ready to help anyone with anything in relation to the tax matters. And this person, this person here, he is actually he has a store selling a meatball soup, and this is him sharing his experience dealing with small business owners in tax matters with tax officers. He's been involved with the Friends of Tax for a few years, and he's highly regarded as basically, well, the elder of the community. So he often is invited to seminars or talks. And one of the interesting activities conducted by the group is that they often have workshops providing support with fellow members of small business owners in relation to taxation matters. Like what is shown here in this picture, this lady here, she is showing her completed tax return that she completed in a workshop conducted by the Friends of Tax community. So I imagine with such activities, that is conducted together by the tax office and the members of the Friends of Tax community. I suppose they have, well, quite low distance of social distance. So what I'm doing is basically really simple. I ask them to fill out the questionnaire, the Emory Burgado's questionnaire, and then compare the questionnaire of those who belong to the Friends of Tax community and taxpayers who are not belong to that community. And the result is something like this. From the questionnaire, it can be seen that the social distance score, the average of social distance score from the member of the now Friends of Tax community is significantly lower than the average score of those who are not belong to the Friends of Tax community. And this is actually quite expected. If we have a look at, if we return to the activities conducted together by the Friends of Tax and the tax office. And another interesting result is that those who have employment as in a private company, employees as employees in private companies, and also have additional, well, side job as a small business owner, they have a significantly larger social distance compared to taxpayers whose sole occupation is small business owners. Whereas in terms of gender or education and age, there is no significant difference between in the social distance score. So the takeaway points that I'm having here at the moment is that there is probably enough. Well, there's probably an evidence that the overall social distance score between the taxpayers and the tax office is rather large in Indonesia. So it is unsurprising that the compliance rate is rather low. And then if you want to make them more compliant with the tax rules, then one road that can be taken is by making the social distance between the two parties is lesser and lesser. And one thing that can be tried is what has been shown by the Friends of Tax community, where they work together closely with the tax office in conducting workshops in relation to taxation, and the tax office providing assistance for the Friends of Tax community in terms of business. The assumption is that when the tax office help the business grow, and once the business grows, the tax base will grow as well. And when that happens, then hopefully, if they pay their taxes, then it is a good thing to do. If that can happen, and then the mutual respect with the two parties can actually build, then it is perhaps a good way to actually improve the compliance of individual taxpayers, at least in the sample that I'm discussing at the moment. So that's probably all that I have to say. I know that I still have a lot of time. Then perhaps it is a good thing to have a discussion. Thank you.
Thank you, Kristian. Okay, well, indeed, we've got plenty of time for discussion here. So if you have any questions for Kristian, please type away in the chat box and we'll get those questions to him. Maybe I can start, Kristian. So I was having a few thoughts as you were speaking.
Yep.
The basic idea was that there's some underlying relationship between social distance and tax compliance. I wasn't sure, maybe you could elaborate on what you see the mechanisms as being. So how is it that there is this causal link from social distance to tax compliance?
Yes, there has been a literature that I've been reading, and first that I noticed in the literature is that the work of the scholars, tax scholars from the Australian National University. The name escapes me, unfortunately. And basically, she was doing a research that says that most taxpayers are basically compliant, and one of the things that she was advocating was that the compliance was partly shaped on the social systems. The further you are apart from the taxpayers, then it is more difficult for you to make them comply. And there is also another empirical research in Australia where basically there is a mass marketed, there is product of tax avoidance, like what was discussed by Jolie yesterday. And it was in the 1990s, and the mass marketed tax avoidance scheme was greatly embraced by taxpayers, particularly in the northern part of Western Australia, by the miners, those who work in the mining companies. And the mining companies normally located far away from anywhere, in the middle of nowhere, in I think the place was Pilbara. And one of the reasons of the highly popular mass marketing tax avoidance scheme was that because of the distance between where they work and civilizations, and they found that they are located far away from the government, they are located far away from public services, they are located far away from the cities. And the fact that they felt they're being distanced away from anywhere, they felt that there's no support for them. And then when there is an opportunity to actually reduce the tax that they actually have to pay, then they embrace it quite fully. And the extent was the scheme was going on for some times until the Australian Tax Office dragged it on using the anti-avoidance provisions. So in Indonesia, the tax office was basically seen as not as a good partner with business, especially those with individuals. Most people say that when they pay taxes, they don't actually say anything in return that they actually enjoy. They still have their roads in front of their house, not actually taken care of. They still have to pay a lot of money for medications. They still have to pay a lot of money for education. So why pay tax? Okay. So this is the challenge faced by the tax office. And sure. The fact actually makes it rather distant.
Okay, Kristian, so you have a point and a question in the chat. I don't know if you can see the chat.
Yes, I
do. From David Massey.
Yes. I'm impressed by your friends of tax. Do you have any suggestions for tax administration that have gone almost totally digital and no longer have face-to-face interaction with taxpayers? Should we expect to see all in compliance rather than approaches being the answer to non-compliance? Yes, for me, this is rather worrying, but being digital is actually part of there are two ways of making people comply. The first is by making less opportunity to comply, like information exchange, for instance. It is making it difficult for people to evade taxes. And the second route of making people comply is actually by making them close to you. And it doesn't have to be in the form of face-to-face meeting, the fact that they feel that the tax office was there, that the country or the state is actually there, and give them assistance is sufficient to establish, to make the social distance closer. And this has been done particularly in the event of the COVID-19, where workshops were conducted not online, not face-to-face, but by conference like this. And this is the thing that I think, well, can still be maintained. So yeah, you don't have to do face-to-face meeting. You can do it online.
Okay, there's another question in the chat as well, from Joe Fang.
Yep. Even though the operational location is far away from tax agencies, they generally have their offices in cities or paperwork. What are the theoretical mechanisms in place here? Well, yes, in Indonesia, we have tax offices in most places. And there are two routes in basically lodging tax returns to the tax office. You can either doing it manually using pen and paper, or you could do it online by using the internet. The key question is whether the tax office can actually provide assistance or support for the taxpayers, when they can be seen as provider as the one who actually provides support for the taxpayers. Then I would say that it is a very good reason to actually maintain the social distance, not to get too far apart, but to actually making closer together. I hope that answer the questions.
Yeah, there was a follow-up question there as to if the distance gets a little too close, does that not encourage corruption?
Oh, yes. This is something that we had a huge problem with collusion and in the past. And at the moment, the collusion was still there, but it was significantly gone. And what we did to basically eradicate the collusion was that we conducted what we call tax office modernization, so-called modernization, which is basically a reform that making it more difficult for the tax office to collude with the taxpayers. And there is also a mechanism of whistleblowing mechanism, and basically anyone can report anybody. If you're not happy with the tax officers extorting you some money, then you could simply send an email or make a call, and something will be done. And there are actually a number of tax officers who were in jail because of the collusion. I won't say that the collusion is totally gone. I'm pretty sure they're still there, but it is what I think we have been successfully significantly reduced the amount of collection between the tax officers and the tax office.
Okay.
Maybe
one question from me again, if that's all right.
Yep. No worries.
So I used to work for the British Tax Authority, and let's suppose you're correct that there is this relationship between social distance and tax compliance. The challenge always seemed to be whether we as a tax authority were capable of systematically manipulating the level of social distance, for instance, on a kind of a national scale. Are you suggesting that you think that might be feasible in Indonesia?
Well, at the moment we have in Indonesia, the tax office in Indonesia have the so-called business development service, which is basically an effort to provide assistance for the business, small business owners to grow their business. And it is still in an early phase of applications, but I think the efforts is quite commendable. The BDS system was regarded as one of the key efforts in improving compliance in Indonesia. And the recent report on tax administration published by the OECD mentioned this effort as well. So I think, yeah, there are resources in Indonesia that we can use. At the moment, we have a cooperation with a number of state-owned companies to use what is the contribution made by companies for social
responsibility and all.
That's corporate social responsibility, CSR. Yeah, they use the fund from the CSR as part of the support as part of the support for the small business owners.
Okay, thank you very much. So, do we have any more questions for Kristian? Okay, I don't see any more, Kristian, so thank you for that.
Thank you, Matthew.